All right, today we're breaking down a really powerful financial tool for Canadian business owners, corporate-owned life insurance. Now, I know that sounds a bit complicated, but stick with me because it's actually a brilliant strategy to protect your business and do it in a super tax-smart way.
So let me kick things off with a question for all you entrepreneurs out there. How are you paying for your life insurance right now? If you're like a lot of people and using your personal after-tax money, well, you could be overpaying by thousands of dollars every single year.
But the good news is there's a much, much smarter way to do this. By using your corporation, you can take advantage of the big difference between personal and corporate tax rates. We're talking about the exact same insurance coverage for a whole lot less.
Okay, let's make this real with an example. Meet Bert. He's a successful business owner and his personal marginal tax rate is a whopping 49.5%. Ouch. But his corporation, it only gets taxed at 15.5%. You see that huge gap? That's our opportunity. And this is where it all clicks. Look at these numbers. For Bert to pay a $10,000 insurance premium personally, his company has to earn almost $20,000. Why? Because he loses nearly half of it to personal tax. But if the corporation pays that exact same premium directly, it only needs to earn about $11,800. That is a savings of almost $8,000 in required profit. That's huge. So right about now, you're probably asking two big questions. One, how is that massive savings even possible? And two, if the insurance payout goes to the company, how do you get that money to your family without the tax man taking another huge bite? Well, the answer to both questions is a very special, kind of secret account. And that brings us to the absolute heart of this strategy. It's something called the Capital Dividend Account, or what everyone calls the CDA. This is your tax-free gateway. So what is this thing? Well, think of the CDA like a special bucket or maybe a running tally that exists only on paper inside your corporation. Its only job is to track certain kinds of tax-free cash that your company receives. And the big one for us, the death benefit from a life insurance policy. And this is the magic of the CDA in 3 simple steps. Here's how it works. When the time comes, the insurance benefit is paid directly to the corporation. Then that full amount gets added to the balance in the capital dividend account. And from there, the corporation can pay that money out to its shareholders, your family, as a dividend that is 100% tax-free, no strings attached.
Okay, now as with any really good tax strategy, you've got to know the rules of the game. And here, the rules can change quite a bit depending on who the insured person is. Are they just an employee, a shareholder, or, as is often the case, both? And this is a really, really important distinction. See, for a key employee, the company can often write off the premiums as an expense. That's good for the company. But the employee has to declare it as a taxable benefit. Not so good for them. Now, for a shareholder, the rules are even tougher. The company cannot deduct the premiums, and the shareholder still gets hit with a taxable benefit. So that naturally leads to the big question for most business owners. What happens when you wear both hats? You're an employee running the show day to day, but you're also a shareholder who owns the place. Which set of rules applies then? Well, the Canada Revenue Agency drew a very clear line in the sand, and it all boils down to one number. 10%. If an employee or someone related to them owns 10% or more of any class of the company's shares, then boom, the tougher shareholder rules automatically apply. Let's put this into perspective with another quick example. Meet Louise. She's the financial controller for her company, so she's a vital employee, but she also owns 15% of the company's shares. So here's the deal for Louise. Because her 15% ownership is over that 10% line, the shareholder rules kick in. This means if her company paid her insurance premiums, it wouldn't get a tax deduction for them, and Louise would have to add that whole amount to her personal income and pay tax on it. So in her case, the best solution is actually the simplest one. Louise just pays her own premiums personally. All right, let's tackle one last common real-world scenario. What happens when you've got a policy on a key employee, and then that employee leaves the company? Can they take the policy with them? So this is Yvette. Her company took out a term life insurance policy on her years ago because she was just that important to the business. But the company went through a merger, and unfortunately, her position was eliminated. Now, as part of her severance, the company did something pretty cool. They just transferred ownership of the policy right over to her. And here's the key detail. Because it was a simple term policy, it didn't have any cash surrender value. That means there was no policy gain for the corporation to report. For the company, this made the transfer really clean and simple from a tax perspective. But, and you really need to hear this, just because it's simple for the company doesn't mean it's simple for the employee. The person receiving the policy, in this case Yvette, could still get hit with the taxable benefit. The rules here can get really complicated, which is why you absolutely have to get professional advice in these situations. Don't try to wing it.
All right, let's bring it all home and wrap this up with the 3 big takeaways. Number 1, use your corporate dollars. It's way, way more tax efficient. Number 2, the capital dividend account. The CDA is your best friend. It's the key to getting the money out tax-free. And number 3, know the rules, especially that 10% ownership line that separates employees from shareholders. And that leaves you with one final question to chew on. Take a hard look at your own business insurance setup. Is it truly structured for maximum tax efficiency, or could you be leaving thousands of dollars on the table? Thanks for joining us.